I always hold 5% physical gold, and then I toggle the what I call liquid paper gold between 0 and 20. And I very recently, right after Kevin Warsh gave his speech, I said, this has got to be the bottom for gold. And I doubled my gold exposure, and I actually took a position in miners for the first time in a very long time. And they were down like 35% since the February highs, and gold was down like 20%. So I said, this idea that Kevin Warsh is now going to aggressively raise interest rates heading into the midterm elections, directly a direct affront to the president who put him in place to cut interest rates. If anybody believes that Kevin Warsh is going to be raising interest rates heading into the midterms when not one member of the FOMC voted to raise interest rates after we had a 4.2% headline CPI print, I think that's crazy. The worst case for gold, Daryl, is that the worst case scenario for gold would be that the Fed doesn't do anything, because I don't think they're going to raise interest rates. I mean, that would obviously be the worst case, but I think the worst scenario is that the Fed does nothing, and the best scenario is that they start cutting rates towards the end of this year, because what I see is the rate of change of inflation is going to be going down, the second derivative, from 4%, 4.2 to around 3, maybe even a little lower. And that's based on five-year forward inflation expectations, CRB index, oil prices, money supply, Federal Reserve balance sheet growth. All those things tell me that we are going to have a lower rate of inflation. Let me be very specific, because sometimes people say I have an arcane way of speaking. The prices of goods and services will continue to rise. They're not going to go down. That's deflation. I'm speaking of disinflation. So the rate of change will be falling. That's it. That's all I'm saying. But when that happens, your investments have to change. So if growth and inflation are now slowing, as opposed to when everybody was on one side of the boat, everybody was saying, oh, Kevin, now all of a sudden the Fed has religion and they're going to now hike interest rates aggressively towards the end of this year, maybe 2 or 3 times. Not going to happen. So what gold loves more than anything is falling nominal rates and falling real interest rates. That's why sometimes people say, oh, gold's down when inflation's up, because if nominal rates are expected to rise, that's not good for gold, because gold is money that doesn't pay interest. Gold loves it when real interest rates are falling. And that's what I expect to happen. And I expect nominal rates to be falling too. And when you think about the miners, the energy they need to pull gold out of the ground is crashing from $120 a barrel back down to, we're actually in the 60s now, believe it or not. So, at least for now. So I doubled gold, physical gold, and I took a position in the miners. So I think it's great news. Now, let me just play this out too, if I hopefully don't interrupt myself again. So when and if we have a liquidity crisis, everything gets sold. That could happen, later on in 26 or 27. And that means gold will have a temporary, decline. But after that, when Warsh assents to the inevitability that he has to print trillions of dollars, then I think you're going to see gold shatter its all-time previous highs and go towards $10,000 an ounce. That's, if I could just give you what my scenario is, because I think we're going to be, unfortunately, subject to intractable stagflation for a very, very long time. Slow, little to no real growth and higher rates of inflation as a direct response of the UBI and the TARP and the trillions of dollars that the Fed has to monetize on the other side of the next recession. Well, as I said, 2 things. First of all, the miners are going to go higher because the price of gold is going to go higher, because everybody's off sides thinking that the Fed is going to be very hawkish, when, as a matter of fact, they're going to be more dovish, because when the June inflation data is reported, and it'll be reported in July, people will be like, wow, I can't believe we were worried about the Fed raising interest rates. He might actually cut. So all the rate hikes go off the table. Rate cuts get priced in. And when you price in a nominal drop in interest rates, gold loves that. So if gold is going to go higher, the stuff that the miners are pulling out of the ground is going higher. And the cost to pull the stuff out of the ground goes lower because energy prices have crashed. That's great news for the miners. Mm-hmm. That's why I took it. That's not like you said. You started the question with a liquidity event. When and if we have a liquidity event, which will be after we are into this recession, then everything gets sold and the miners will get sold too. And that's when I climb aboard what I've termed the four horsemen of the economic apocalypse, which is you have to have cash, you have to have short-term treasuries, you can have some gold, physical, but not the miners, but everything gets sold, remember. So cash, the US dollar, treasuries, and shorts. You must be short the market because everything goes to a correlation of one. Doesn't like right now, as a money manager, the last 3 or 4 weeks, we were positioned ahead of this non-farm payroll report, which really pooped the bed. Came in like 57,000, and the household survey showed a loss of like a half a million jobs, 500 and something thousand, in the household survey for the United States. We positioned, so between Warsh's meeting and yesterday's non-farm payroll report, we had already positioned the portfolio in the miners, in gold, and we sold our exposure to tech and bought dividend-paying, low volatility stocks, which were up big on Thursday. Mm-hmm. So you notice, and that's what the beauty of the second derivative, having a model so my model says the rate of change of inflation is going to fall, the growth is going to slow. That means interest rates are going to come down, which means you want to be switching into your defensive low volatility stocks. When you think about freedom, a free economy and a free market, the number one thing that has to be free is the cost of money. It should be a function of the supply of savings versus the demand for money. That's a market right there. I want to take out a loan, and the people who have saved money put it in the bank, and the bank and the borrower, the lender and the borrower, they agree on a price for the money based on a risk profile and inflation. That's how it should work. 12 monkeys that get elected to serve on the Federal Open Market Committee, like the 12 apostles, they should never have the right to not only, repress interest rates, send them artificially lower, decade after decade after decade, which is happening really since the 80s, but really became salient and prevalent after the year 2000. But they also control the amount of money that is in the system. They manipulate money supply by printing credit. And when you heavily influence the supply, the broader monetary aggregates, and the cost of money, everything else gets deformed. The savings and investment dynamic gets blown to pieces. Asset prices get blown up. The middle class gets eviscerated, and it all lands at the government, the Treasury and the Fed. The Treasury spends too much. They borrow too much. The Fed facilitates that by keeping interest rates low. And what we've done is we've gone from a regime of let's just loan banks money overnight in something called a discount window, treasuries for credit at a discount. That was not the 1913 construct of the Federal Reserve, to let's cancel recessions, let's keep the unemployment rate from ever ticking up, and let's prevent the stock market from ever having a downtick. That's the new dual mandate of the Federal Reserve is perpetual bull markets in stocks and never to have a recession. Because you know why, Daryl? And this is very simple. It's a fact. They know that the level of over-financialization of the economy and the extent at which asset bubbles are prevalent now, that when we have a recession, and they have not abrogated the business cycle, we will have a recession. It will happen. They're doing their best to hold it at bay by printing trillions of dollars, but it'll happen. When it happens, it will not be a recession. It will be a depression. And since the government's balance sheet has been so severely impaired during the last two recessions, or actually the last three recessions, so 2000, 2008, and 2020, the government's balance sheet has been so overextended that it won't be able to easily rescue us the next time. 3 strikes, you're out. It means a lot to me. It obviously means a lot to you. It's not so much. There is an oligarchy and a plutocracy in the United States too. Don't kid yourself. But it is government. It's government. It's power that corrupts. And when power is left unchecked the way it has at the central bank, things run amok in the economy, and that's where we are right now. This is an unelected. This is an appointed cabal of individuals who have made themselves demigods The beautiful thing about this economy and its construct at its foundation was that it balkanized power. It no more kings. It wasn't even really the foundation of this land wasn't even a sure thing that we'd have a presidency. It was a republic, a democratic republic, and you wanted to bring power as close to individuals as possible, and that has been obliterated by the current system of a treasury that spends like drunken monkeys and a central bank that monetizes most, if not all, of that debt. And this is where we are now, where people don't even, and that's why I come on channels like yours, and people who, I hope you have a huge audience, and I hope it gets bigger and bigger, God willing. Yeah. And people could avail themselves of this knowledge of what's is actually happening. It's not, the answer, Daryl, isn't socialism, where everybody, the top of the ladder gets cut off and everybody's on the bottom rung. That's not the answer. The answer is more freedom in markets, more power to individuals, and they decide what to purchase. And at